Tomahawk cruise missile contains 500 ounces of silver, 15.5 kilograms, packed into guidance systems, circuit boards, and electrical contacts that require the most conductive metal on Earth. Exhales sharply. When it detonates, the silver doesn't survive, it vaporizes, scatters into particles too small to recover, gone. Permanently removed from the planet's usable supply. Now here's the thing. That same disappearing act is happening, silently, invisibly, across every industry on Earth. Every solar panel, every electric vehicle, every AI server rack, every 5G antenna. Silver goes in, it doesn't come out. Curious. Unlike gold, which is mostly stored in vaults, silver is industrially consumed and often not recycled due to the tiny amounts used in individual electronic components. This consumption of capital is a historical precedent that hasn't been seen on this scale since the mid-20th century, when silver was removed from circulating currency. Half of all the silver humanity has ever mined is already gone, and the industries consuming what's left are accelerating, not slowing down. Size. I'm John A.G. This is John A.G. Markets. Today I'm going to show you exactly who's buying all the silver, why the supply can't respond, what happens at the tipping point, and the bear case that nobody in the silver space wants to hear. Curious. Let's get into it. Let me walk you through the demand stack, because when you see all of these industries layered on top of each other, the picture becomes very hard to dismiss. Solar. According to Bloomberg NEF, solar manufacturers and the largest industrial consumers of silver are accelerating efforts to reduce silver intensity in photovoltaic modules. Silver demand from PV installations is expected to fall to roughly 194 million ounces this year, marking a 7% year-on-year decline. This drop comes even as global solar capacity continues to expand by around 15%. Simply put, as manufacturers are using less silver per cell, total silver demand from the sector is projected to decline. Exhales. Now, I want to be honest with you here. The solar story has changed. Thrifting is working. Manufacturers are reducing the silver content per panel. Longi Green Energy announced plans to replace silver with base metals such as copper in its back contact cells, with mass production expected in the second quarter of 2026. Similarly, Jinko Solar signaled large-scale copper-based panel production. But, and this is critical, certain technologies, such as TOPCon cells, are less compatible with alternative metals due to high-temperature fabrication processes. As a result, silver continues to play a central role in high-efficiency solar designs, even as overall usage declines. Curious, so solar demand is declining from its peak, but 194 million ounces is still an enormous number. That's still roughly 1/4 of total mine supply consumed by a single sector: AI and data centers. Other industrial uses offer partial relief. Growth in data centers, artificial intelligence technologies, and automotive electronics is expected to sustain silver consumption across several end uses, mitigating some of the PV losses. Thoughtful, solar photovoltaic installations are expected to consume over 120 million ounces this year alone, and the deployment of AI-specific servers, which use 3.5 times more silver than traditional hardware, has created a demand floor that did not exist 5 years ago. Surprised. 3.5 times more silver per AI server than traditional hardware, and the build-out is just beginning. Electric vehicles. China has the largest EV market in the world, and EVs consume about 67% to 79% more silver per vehicle than internal combustion cars, due to more complex control systems and power electronics. Curious. Notably, the automotive industry will account for 59% of the share by 2031. Military and defense. This is the demand source that operates in the shadows. Silver is irreplaceable in missile guidance systems, satellite communications, and advanced weapons electronics, and when a missile detonates, the silver is permanently destroyed, unrecoverable. Size. The ripple effects are being felt across the regulatory landscape. Governments in silver-rich nations are beginning to reconsider export duties and mining royalties to capture a larger share of this new oil. In the United States, the scramble for silver has also triggered discussions regarding the strategic importance of domestic mining, potentially easing the permitting process for new projects to ensure a steady supply for the defense and technology sectors. Now add it all together. Industrial demand now consumes more than half of annual silver supply, and much of this demand is highly inelastic. Solar energy, electric vehicles, AI infrastructure, data centers, and advanced electronics all require silver regardless of price. So demand is stacking from multiple industries simultaneously. What about supply? Total global silver supply is forecast to rise just 1.5% to a decade high of 1.05 billion ounces in 2026, with mine production expected to increase only 1% to 820 million ounces, a pace that continues to fall short of industrial demand. 1%. That's the supply response to a metal that more than doubled in price last year. Here's why. New mine supply remains structurally constrained. Approximately 70% of global silver production is extracted as a byproduct of base metal mining, primarily zinc, lead, and copper, meaning supply responses to rising silver prices are governed more by the economics of those host metals than by silver itself. So you can't just mine more silver. Silver production depends on whether it makes economic sense to mine more copper, zinc, and lead. If it doesn't, silver supply stays flat, regardless of silver's price. Silver supply is inelastic. Miners cannot flip a switch and bring new supply online. Projects take a decade to develop, permitting frameworks are clogged, grade profiles are falling, and capital markets aren't funding exploration. And the deficit? The silver market is expected to remain in deficit for a sixth consecutive year in 2026. The Silver Institute projects a deficit of around 67 million ounces in 2026. This underscores the key dynamic driving the silver market right now. There simply isn't enough metal. Overall, 2025 saw the fifth successive deficit, estimated at a sizable 95 million ounces. For 2021-25, this results in a cumulative deficit of almost 820 million ounces. 820 million ounces of cumulative deficit in 5 years. That's nearly a full year of global mine production that simply wasn't met. Now here's the part that separates silver from every other metal on the planet. And it's the part that even most silver investors don't fully grasp. Much of this metal is consumed and effectively removed from circulation, unlike gold, which is rarely destroyed. This creates a persistent drawdown of available above-ground inventories. Although silver is infinitely recyclable in theory, a significant portion of it becomes unrecoverable in practice. Unlike gold, which is often stored and hoarded, silver is widely used in industries, electronics, and everyday products. That means a large portion of it ends up embedded in devices, worn away, or discarded after use. Think about what that means in practice. When silver goes into a solar panel, it stays there for 25 to 30 years. Then the panel goes to a landfill. When silver goes into an EV's battery management system, it's embedded in components that are never individually recycled. Some silver is simply lost, either through wear, disposal, or use in applications where recovery is impractical, like silver nanoparticles in textiles or medicine. Some silver will never be reused. Recycling silver isn't always cost-effective. If the cost to extract silver from a product outweighs its market value, it might not be recovered at all. Gold is different. Nearly all the gold ever mined still exists. It sits in central bank vaults, in jewelry boxes, in ETF storage. When you buy gold, you're buying something the world has been accumulating for 5,000 years. When you buy silver, you're buying something the world is simultaneously accumulating and destroying. That distinction is everything. Now layer on top of everything I've just described the single most significant supply-side development in years, and it happened on January 1st, 2026. China reclassified silver from an ordinary commodity to a strategic material, placing it in the same category as rare earths. From that date, silver exports require government licenses. Curious. From January 1st, China implemented a new licensing regime for silver exports, restricting eligibility to producers with a minimum output of 80 tons per year and a $30 million credit line, effectively limiting exports to 44 companies. The move is intended to ensure domestic industries, including renewables, consumer electronics, and electric vehicles, remain sufficiently supplied. Peel Hunt estimated that 60% to 70% of global refined silver supplies could be affected, as much of China's silver output is a byproduct of copper, zinc, and gold processing. Exhales sharply. Let me say that again. China currently controls between 60% and 70% of the world's refined silver supply. Therefore, even a partial restriction instantly creates GL. O-ball supply shock. Surprised. Silver is the new rare earth, at least when it comes to China's export controls on strategic commodities. The South China Morning Post framed it that way directly. If China reduces exports by 50%, global deficits could exceed 5,000 metric tons annually, compounding existing shortfalls. This scarcity will disproportionately affect industries with rigid demand profiles, such as renewable energy and electronics, where substitution is either impossible or prohibitively expensive. And the U.S. isn't standing still either. The U.S. elevated silver to strategic metal status in November, with its inclusion on the U.S. Geological Survey's critical minerals list due to its important role in building out advanced energy and defense technologies. Silver's inclusion on the list makes it a potential subject for a future Section 232 investigation, a formal process to determine if imports of certain products or materials are harming national security. Both superpowers now classify silver as a strategic material. That's not a coincidence. It's a recognition of the same math I've been walking you through. So what happens when investment demand and industrial demand compete for shrinking supply simultaneously? Falling demand in these sectors will be largely offset by physical investment demand. The Silver Institute forecasts bar and coin demand will rise by 20% to a 3-year high of 227 million ounces as Western investors finally jump on the bandwagon. Add 227 million ounces of investment demand on top of 650 million ounces of industrial demand, against 820 million ounces of mine supply and roughly 190 million of recycling. The math doesn't close. And every year it doesn't close, above-ground stocks shrink further. The visible symptom of this crisis is the sharp depletion of global silver inventories. Both Western and Asian vaults have been drawing down metal at a historic pace. COMEX registered inventories in the United States are down nearly 70% since 2020. London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai inventories have fallen to their lowest level in a decade. 6 consecutive years of projected supply deficits underscore the structural difficulty of bringing new silver production online, with above-ground inventories serving as a partial and finite buffer that may itself become a price-supportive signal as it depletes. Now the bear case. Because if I only give you the alarm, I'm scaring you, not informing you. 1. Solar photovoltaic manufacturers have systematically reduced the amount of silver used per solar cell through thrifting. If thrifting accelerates faster than new solar installations expand, industrial demand from this sector could decline even as global renewable energy capacity grows. This is not a theoretical risk. Silver content per cell has declined materially over the past decade, and further reductions are technically feasible. And it's not just thrifting. Shanghai IcoSolar has already launched silver-free solar cells. If that technology scales, the largest single source of industrial silver demand could shrink dramatically. 2. Silver industrial fabrication is forecast to decline by 2% in 2026 to a 4-year low of around 650 million ounces. As was seen last year, the weakness will be underpinned by developments in the photovoltaic sector. While global solar installations are expected to continue rising, ongoing thrifting and outright substitution away from silver will result in falling silver PV demand. Industrial demand is actually projected to decline this year, according to the Silver Institute's own analysis. That's a critical nuance that most silver channels omit. 3. Physical silver's reliance on above-ground inventories to bridge the annual supply deficit introduces a separate consideration. Large-scale liquidation of stored bullion, whether from institutional holders, exchange inventory drawdowns, or government sales, could temporarily suppress prices even when the underlying supply-demand balance remains in deficit. 4. High prices bring challenges. Investors benefit, but industrial users face rising costs. Prolonged price pressure could reduce demand and cause more volatility. At $84, silver's own price is already causing demand destruction at the margins. If prices stay elevated, more manufacturers will invest in substitution research. 5. The silver market has seen significant supply chain disruptions this year, as physical metal has been trapped in the wrong location and in the wrong form. At the start of the year, significant amounts of silver flowed into the U.S. as bullion banks built a stockpile to avoid potential tariffs. Although the U.S. government has said precious metals are exempt from tariffs, the metal has remained in New York. New York vaults are overflowing with silver, and refiners are at capacity when it comes to recycling the metal. Buyback premiums for scrap silver are significantly lower in North America because of the glut. That last point is crucial. New York vaults are actually overflowing with silver right now. The tightness is real, but it's geographically uneven. London is tight, Shanghai is tight, New York has a surplus. The shortage narrative is more complex than silver is running out everywhere. Understanding that nuance protects you from oversimplified takes. That's 5 real bear arguments. They deserve weight. Let me tie this together with a framework rather than a prediction. Because predictions are entertainment. Frameworks are tools. These factors indicate a fundamental shift in silver's valuation, moving it beyond an industrial commodity to a triple identity asset: industrial, monetary, and strategic. That triple identity, industrial input, monetary metal, and strategic material, is what makes silver's situation genuinely unprecedented. No other commodity sits at the intersection of the energy transition, the AI revolution, the global rearmament cycle, and the monetary system simultaneously. But here's what I want to leave you with. By the time a silver shortage becomes front-page news, by the time mainstream outlets are running segments about solar manufacturers unable to source metal or defense contractors competing with tech companies for the same physical supply, the price will have already moved. Markets price in expectations before reality arrives. The question isn't whether these demand trends are real. The Silver Institute, Oxford Economics, Bloomberg NEF, and the U.S. Geological Survey all confirm they are. The question is whether the market has fully priced 6 years of cumulative deficit, a Chinese export lockdown on 60-70% of global refined supply, and a consumption pattern that permanently destroys the metal. My honest view, and I'll tell you next week if I'm wrong, is that it hasn't. Not fully. But I could be wrong about timing. Thrifting could accelerate faster than installations grow. New York's silver surplus could migrate to where it's needed. Recycling technology could improve. These are real scenarios that would change the math, so study the data. Don't just take my word for it. Every number I cited today, the Silver Institute's supply-demand projections, Bloomberg NEF's solar thrifting data, the Peel Hunt analysis on China's export regime, the COMEX and LBMA inventory drawdowns, the Metals Focus industrial demand forecasts, all of it is publicly available. I'll link every source in the description. Verify what I've shown you, challenge it, and ask yourself one question. If 4 of the most powerful industries on Earth, solar, AI, electric vehicles, and defense, are all competing for the same metal, and that metal gets permanently destroyed when they use it, and the world's dominant supplier just locked the door, what does that math look like in 5 years? If this assembled a picture you haven't seen in one place before, subscribe. Share it with someone who doesn't realize that their phone, their solar roof, their car, and their country's missile defense all depend on the same finite disappearing metal. And drop your take in the comments. Which demand source do you think matters most for silver's future? I read every single one. Invest with logic, prepare with data. I'm John A.G. This is John A.G. Markets.